Rav. Welcome to the Everyday Investor. So excited to have you with us. Remember, whenever you're faced with any type of investment opportunity, you always want to ask 4 questions to start. 1, what is the return on investment? 2, when do I get that return along with the investment amount that I put in? 3, what is the minimum amount needed? And 4, what is the risk, the worst case scenario? This show is designed to help us grow our money. We all spend our precious hours, 168 hours in a week. We spend a lot of them working to make money in order that we can live. We take our time, we go to work, we make money so that we could provide. But imagine a world if money could make you money, where you could work a little less and have more time for the things that mattered most. Things like family, friends, a purpose perhaps greater than yourself, all that kind of good stuff. Super excited about this show. We're going to be talking about how to make money investing in an apartment conversion. My good friend Darren Voros is on the show. Don't go anywhere. Everyday Investor continues in a moment. Hey, it's Rav. Welcome back. Today we're talking to my good buddy Darren, and he's going to teach us how we can grow our money investing in an apartment conversion. Darren, thanks so much for doing this with me.
Hey, thanks so much for having me on, Rav. It's great to see you and great to be a part of your show.
Yeah, you know, during the COVID times here, we've pivoted, and perhaps this is the way we'll go, even though you're not that far from me. Perhaps, like, let's say you travel a lot. Let's say you're in Vancouver doing something, and I'm here in Toronto. We wouldn't be able to enjoy a bottle of wine that you have behind you, but we would still be able to do a remote show. So I'm very grateful for this kind of setup, and let's kind of see what happens. But so the last time we did something together, you were in studio, right? Was that like last year?
Yeah, last year, spring of last year. I just got back from Mexico. I was traveling there for the full winter. I was there for 3 months, and I had just come back. And I think a couple of days later, I was in studio with you recording that session.
And so I'm a big fan of vitamin D and really protecting our brain health. Here we are in the latter part of 2020. What are you going to do this year? Do you have any plans to get some sunshine, or are you just kind of staying put and following the advice of the protocols? And I always say there's a big difference between restrictions and suggestions. And so we could protect ourselves from COVID, but our mental health may not be at an optimal place. So I'm still thinking about, how do I get my sunshine for a few weeks, in the winter? What's Darren thinking?
Yeah, just playing it by ear at this point, just seeing what's happening and how things are progressing. I'd love to still get away for the good part of the winter. That was always the goal with real estate investing. We always talk about our why we're in it. My biggest why was I don't like being cold and don't like being in the Canadian winters. I love being here in the summer. But the opportunity had presented itself for the last couple of years for me to get away for months at a time. This year might be a little bit different. We've got 2 projects, potentially a third one that we're looking at right now. So I might need to be here a little bit more and be a little bit more present this year. But I kind of balance that. These are projects that I love to be involved with. So, they keep me going, keep me motivated, keep me excited. But I can guarantee that I will dip out at some point for the winter to get away and get a little R&R for sure. That's really important to me.
No, it's very important. That's great. We have some mutual friends in Michael and Scott, and they have an outfit, a Keyspire, an education company on real estate investing. And of course, you need great teachers to be a part of that, and you were one of them. But now, they're shifting online as well. So what have you been doing in terms of nurturing people other than us being blessed here to have you on Everyday Investor? Are you still teaching, or are you now continuing just to focus on live deals that you're investing in and helping people to invest in those deals with you?
I'm doing both. I think it was really important for me to keep educating. Keyspire, like as you mentioned, stopped doing their live events, and they kind of went down to a skeleton crew. And I also wanted to kind of launch my own brand and my own journey. And the guys, Michael and Scott, were very supportive of that. And so I launched a YouTube channel earlier this year in 2020. And I'm just just now passed my 1,000 subscribers and my 4,000 watch hours. So I was able to monetize my YouTube channel in about 7 or 8 months. So that's been a huge accomplishment for me. And then of course, yeah, my focus has always been my real estate investing business. And so that was really first and foremost. And I started pouring more energy into that and being able to grow it. I really wanted to scale it this year. I wanted to double my unit count and double my net worth. Sorry, not my net worth, my portfolio worth in 2020. And so that we're just about coming up on that now. So super exciting year for me and being able to do some of the things that I've wanted to do for a while.
And if people want to get a hold of you on YouTube, where do they go?
YouTube.com/Darren Voros. Super simple.
Nice. And so what do you like doing now? I mean, you've been in this game for a long time and you have a large portfolio, but kind of do you have a niche, or is it whatever? I mean, you and I, we've done every type of investment vehicle. These days, I really just want to make the highest returns with the least amount of risk and passively. You're a little bit different. I know you want to make the highest returns, lowest risk, but you don't mind being active, which is great because now I have somewhere to put my money into Darren Voros' investment strategies and vehicles. But is there a niche? I mean, where you are today, what do you like doing, or is it whatever comes along and the numbers work?
I think that was the big game changer for this year, was niching down, if you will, for lack of a better expression. What I realized was, what do I like to do? Because, I'm at a point in my life where, we've created a certain amount of success in our lives with real estate investing. So now it's like, what are you really passionate about? I'm passionate about a couple things. I'm passionate about construction and development. And I'm also passionate about the Toronto market and I love investing here. So I had to really just figure out a strategy that was part of those two things, development and renovation, and looking at the Toronto market. How do I make the Toronto market work as an investment vehicle for myself and also for my other investors? And so when I looked at those two things, I really came up with a strategy that we're going to talk about today.
No, I love that. And that goes along with highest returns. And if you know what you're doing, least amount of risk, would you say?
Yeah, I think that's really the end goal. How do we set ourselves up for success, mitigate as much risk as we possibly can with any investment, and something that you really love to do and are passionate about.
Yeah, no, I always say knowledge mitigates risk. Knowledge breeds confidence, and not anybody can get into a development. I'm a passive investor in development, as you know. I work a lot with Graybrook. And, they're doing $300, $400, $500 million projects, condominiums, so on and so forth. And usually that's maybe a small teardown or finding some vacant land. You wanted to focus in Toronto. What are you doing? I mean, obviously we're talking about it today. The topic is conversions. So you're actually taking an existing property and converting it to better use? Or is the plan, if you can find it, take some vacant land and do a build up from there?
I think we're looking at both, but the ones that have presented themselves more clearly are the conversion. So taking an existing building and knowing that the zoning is there to convert to multiple units. But that's a much easier thing to find in Toronto, I find right now, than that vacant land or that infill project. So we've been focusing on these bigger lots in these older established neighborhoods that have good zoning, that have good bones for the buildings, and that allow density. And that's essentially what we've gone after.
And so with a project that we're going to talk about today, that's in Toronto?
Mm-hmm. Yeah, we're looking at, we have two that are, one just closed, one is closing next week, and we have one under contract right now, all focused in that sort of High Park corridor. So we're looking at basically, prime High Park. One of our locations is halfway between Keele Station and High Park Station, probably a 3-minute walk. The other one is Dovercourt and Bloor, minutes walk to Ossington Station. And the other one is High Park Boulevard, which is minutes walk to Roncesvalles and High Park on either side. So really prime locations, as I say, in these old established neighborhoods with these big, beautiful century homes, which I love converting.
And Darren, what's your exit strategy? I mean, there's no right or wrong. Can you can flip them, you can hold it for a year, you can refinance, you can hold it for 5 years, or it can be kind of a legacy plan and it just stays with you forever. What's your plan? What do you like doing with these conversions?
We look at them in a couple of different increments. We look at the first 12 to 18 months. That's our renovation time. So that's our development time. Essentially, we're taking the property, in most of these cases, it's a single family dwelling or some variation of that, and we're converting it to 8 to 9 legal units. So there is a process there we have to go through with the city of Toronto and things like that. That's going to take about 12 to 18 months to get through that entire process. So we acquire the building, we perform the initial renovations, and then we do a first refinance. So that's the one that we're going from residential financing essentially to commercial financing, because we've converted the building now to 8 units. And usually with commercial financing, 6 units or more will be what the threshold is. So that's the first sort of phase. The second phase is I ask my investors to stay in for, let's call it a first 5-year term. After 5 years, then we call them sort of 3 options. One is to sell the building and we all exit. 2 is we refinance the building, pay back the capital that's been injected into the transaction, and then we hold that property for another, let's call it 5-year term. Or the third option is we do a hybrid of the 2. We set a sale price, we refinance the property, and one group of partners maybe buys out the other one, and they could hold that asset long term.
Perfect. Let's take a quick break and let's look at one of your projects. We'll get out the paper and pen, marker and pen, and dissect some numbers. You guys don't want to go anywhere. We're going to be taught by Darren Voros on how we can make money investing in an apartment conversion. Everyday Investor continues in a moment. Hey, it's Rav. Welcome back to Everyday Investor. We're talking to Darren. He's going to teach us how we can make money investing in an apartment conversion. So Darren, thank you again for being on the show. So this one that you've done here, this is in High Park?
It is in High Park. Yep, just north of Bloor.
Just north of Bloor, which for those of you that are watching outside of the GTA, Greater Toronto Area, it's a very prestigious area where you can get some old century homes, and they are the best to convert if you know what you're doing. Yours truly does not know what he's doing. That's why I like to learn from a guy like Darren. So let's give it away. I never give it away right off the get-go, but let's give it away right now. What is the return on investment in 1 year on this?
60%, 60.
60.
Yeah, not bad. Now,
that's pretty healthy.
We're going to split that between working partners and capital partners. So our annualized return for our share is 30%.
So what you're saying is if Rav was to put up the money in this deal, and Darren were to do all the work or make sure all the work got done, in the first year, the way you do it is Rav, would have enjoyed a 30% return.
Correct.
Nice. Okay, so let's go through this. What did we do? What was the purchase price?
$2.75 million.
2.7 million. Okay, and we didn't pay that all cash. Okay, so we put a deposit down on this?
Yep. Down payment was, do you want deposit or down payment?
Down payment, that's what I meant.
Down payment. Down payment was $962,000.
962, and is that a certain percentage that you had to put?
Yeah, that represents 35% down payment.
35%.
Yeah.
So talk to me a little bit about that, because somebody could be watching and say, hey, I'm going to live there, so I thought it's 5%, or it's an investment property, so I thought it was 20%. Why is this more than a third that I had to come up with to do what you did?
Yeah, so we're dealing with a bit of a hybrid, as I mentioned earlier. So you've got a residential property essentially that we're converting over to a commercial property. But when you've got a residential property, somebody has to qualify for the financing on that. The bank's always going to look to an individual or a group of individuals to qualify. So we had 3 loan guarantors on this project. And the bank, because of this high purchase price of a $2.75 million property, was only comfortable going up to essentially 65% loan to value, especially with the current conditions of the market and everything that's going on. That's where they felt comfortable financing this with the 3 loan guarantors and the loan to value on this purchase price. So that's why we had to put 35% down.
And when you say 3 loan guarantors, just simply your 3 partners?
There's a group of 5 partners total, but 3 of them were guaranteeing the loan. Yeah.
Okay, but 5 people came together to get you the 962 plus the renovation cost, closing, all that. Is that right?
That's right.
But one person could have done it if they had the money as well.
Yep.
So the return is the same. I'm still going to get my 30% regardless if I'm in it with 10 people or Rav does it by himself.
That's right.
I'm still going to get
proportionate to your share. Yeah.
Proportionate to my share, which is very interesting. So you work all that out. This, I guess, another word for that, Darren, would be syndicate. You syndicate all the players together, Rav and friends. To you're the working partner. We're the money partners.
Correct. Yeah. So we create a shareholders agreement, and we purchase this property in a newly found corporation. And then the shareholders agreement governs the entire project and what everybody brings to the table and what the distributions are based on that.
But just to be clear, Rav just needs to write a check.
That's right.
I don't need to do anything else.
Do what you do best, and I'll do what I do best.
Yes, I like to be, because it's very interesting. The topic of the show is investing in an apartment conversion, but it really could just be called investing passively and make 30%. I mean, if Darren wanted to, you do this yourself, and now you are have some perspiration, in this, and you still do. But if Rav wants to get involved, no perspiration, just the ability to be able to partner with you and split the profits.
Yep. So you could look at it from both sides. We're teaching today about really being on the passive side of investing in a project like this, or being on the working side and being the managing partner of bringing something like this to fruition.
Perfect. Okay. So what else did your money partners put their money towards? So the down payment, 962.
And the closing costs and the associated closing costs with this property, which were $130,000.
130,000. Okay. And then?
And the last little element was the carrying costs, essentially. So we didn't go out and try to bring together $1.5 million of renovation money. We actually financed the renovation. So we're bringing about $150,000 to the table for the financing of this renovation as well.
Nice. And do you want me to add that?
Yep.
Okay. So the interest, right, on the reno. Interest on the reno was how much?
$150,000.
Wow. So that means we had a pretty, they lent us a lot of money to renovate this.
$1.5 million at about 10% annually is the interest rate that we're going to pay on those borrowed funds.
So we bought at 2.7 and we're renovating at 1.5.
Correct.
You're not afraid of the big numbers, eh?
Well, big numbers, big returns, hopefully. That's the game.
Okay, so that's our expense. This is the interest. Here's our closing costs, and here's our down payment. And these three numbers add up to?
Just shy of $1.25 million. So 1.242 is the exact number.
1.242.
Yeah.
That's what I'm in for. Okay. Great. Now let's make some money. Teach me how.
Yeah. So essentially, now we go to that renovation mode I was talking about, that 12 to 18 months, the $1.5 million. So that is, the 1.5 is inclusive of our hard costs and our soft costs. So on a project like this, because we're taking a single family dwelling and we're converting it to 8 units, we're being treated like the Graybrooks, like everybody else who's in development. We're going to have to pay development charges on every unit that's not existing. So we have about $400,000 in development charges and fees devoted to the city. Our construction cost is just around $1 million. So our $1 million is what we call our hard costs, and about $500,000 in soft costs, architects, engineers, city fees, everything like that. So that's where that kind of breaks down to.
Perfect. Now when we're done, there's some cash flow that we're getting. There's appreciation that we're getting. There's a mortgage pay down that we're getting. And then of course, I would guess there's a bit of a lift on the property. But tell me just these ones here. What's my cash flow now in something like this?
Yeah, we're going to be generating about, very conservatively, about $14,000 a year in cash flow.
14,000 from 8 units.
Yeah.
Okay. And then in this area, conservative, what would it go up?
We basically created a lift in the property value of about $500,000.
Oh, this is the forced.
Yes. So,
Okay, that's okay. So you forced it. You forced it to go up 500,000.
yeah,
Okay, and then natural appreciation. Do you include that or no?
we did. Yeah. I mean, at 3%, very conservative number, especially for the Toronto market, would gain us about $150,000 a year in value.
150. And then what I love the most, I always tell people, if I bought something for 500,000 and 20 years later I sold it for 500,000, I wouldn't be upset because somebody paid down 500,000, minus my down payment or whatever the case is. So how much in the first year is my mortgage being paid down?
$93,000.
$93,000. That's a lot of money. So if I take anything else, so I'm making money from the cash flow, that's after all expenses. What's left from the rent, the 8 units that's coming in is $14,000 a year. Passively, it's increasing $150,000, and you're just using 3% of it going up. They're paying down. The tenants are paying down my mortgage, $93,000, and because you did this renovation, it was appraised at at a higher price. You were able to increase the value by $500,000. So we add these numbers up, and what do we have here?
$757,000.
750. Can you see this on the screen? Is it too low? Yeah, you can see it. Okay. Okay, so 757,000 you generated in the first year or so. Remember, whenever you want to see the return on your investment, you take your profit, you divide it by the investment amount. And so 757, if you have a calculator there, let's see what happens. 757 divided by the 1.242.
Yep.
Is
us 60.9%.
61% in the first year. And so if Rav was in the deal with you, I would enjoy 30.5%. No, this is amazing. And so whether you have, Darren, the money in the bank or not to do this yourself, you probably wouldn't, because when you use other people's money, as nice of a guy you are, it's not for being benevolent towards Rav and friends. You're not a charity. It allows you to do more deals even at the same time if you can use other investors that go along with you, correct?
Yeah, and that's what I was saying. We just closed on one. We're closing on another one the end of next week, and we're in contract for another one that's looking to close end of February. So the idea here is we're looking at economies of scale. If we can have multiple projects happening staggered at the same time, our trades can go from one project to the next to the next. We get better pricing. When you're buying 12,000 square feet of flooring at a time, you're getting better pricing. So all of this is, really to drive the costs down on the reno. And make our investors the best possible return.
Love your style, buddy. Thank you so much, Darren, for coming over and having a drink with me like you did in the summer. And of course, we were 6 feet apart. And thanks for doing this show, and thanks for being my friend. Thank you for being on the show and nurturing our viewers.
Thanks for having me on, Rav.
And thank you for watching at home or listening via podcast. Without you, we wouldn't have a show. Make sure you tune in next week, same place, same time. Honey, I love you. I'll be home soon. Bye-bye, everyone.